In this presentation I'll be talking a little bit about the timing of contributions and their tax deductibility to employers and self-employed persons, and also borrowing to make contributions. So let's hit off at this is a little bit from an employer's perspective, this whole presentation. So if you're not an employer and making contributions, then really you don't have much of an interest in this other than general knowledge, I guess. But when can an employer claim a tax deduction for a superannuation contribution? From the 1st of July 2007, an employer can claim a full tax deduction for all superannuation contributions made on behalf of employees, provided that certain conditions are satisfied. Likewise for self-employed individuals. So basically, what are these conditions? Well, there's quite a few of them, and some of them are really quite senseless. So I've hit up just the main ones that probably have some application to most employers. Contributions cannot be accrued and become a deductible. They must be paid. So you can't just post a general journal entry and debit the superannuation expense account and credit a liability payable account. If you do so, those expenses associated to superannuation made in that way have to be written back because they're not deductible. Furthermore, a tax deduction can only be claimed for a contribution made in the year to which the trustee physically receives the superannuation contribution. And so it's important for employers, for example, who are making superannuation contributions by cheque, for example, and they're doing it towards the end of the financial year. If the cheque is unpresented at the end of the year on their bank account, there's no tax deduction claimable. So I advise my clients and pass that advice on that if you as an employer are going to make a contribution and date that cheque 29th or 30th of June, and you want it to be deductible, you need to personally hand it to the trustee of the super fund and receive a receipt from them showing that they received it before the 30th of June. By so doing, you can claim a tax deduction for it, even though the cheque may be outstanding at the time. If the company or the employer is involved with the personal services income measures, or PSI, then there's no tax deduction for the superannuation contributions made on behalf of an associate, meaning your wife or your children or whoever. There's a little bit more to this than meets the eye, and so sometimes some contributions can be deductible up to various limits. And so if you are a PSI area, you just need to talk to your accountant or to us a little bit more about this in the future. An employee can generally claim a tax deduction for financing costs, including interest on money borrowed to pay superannuation contributions. And of course, if the contributions are deductible, then the finance costs will be also. Conversely, if the contributions are not deductible, then the finance costs are also not deductible. And the same is true also for self-employed persons. A couple of tips now for employers. Make sure that your employees are members of super funds before the end of the year. Otherwise, your contribution will be made not deductible. As I pointed out, if they're not a member of a superannuation fund and you've written the cheque, and of course the cheque is unpresented, then you won't get a tax deduction for that expense incurred. And also make sure that the super fund you're making contributions to are complying funds. Otherwise, there's no tax deduction for the contribution. I'll put up there on the presentation the website where you can look up superannuation funds and test their compliance. The third point is that if an employee wants to accelerate some tax deductions, employers want to accelerate some tax deductions on behalf of their employees, generally themselves, you can gear them up in June, make that large contribution in June and get the immediate tax deduction. Of course, then from the superannuation perspective, you've got this large contribution that's coming in June, and of course you can use the contributions reserve account to hold the excess contributions over to apply them in July. And so the company has got the big tax deduction in June, but the super fund doesn't have excess contributions tax because it's used the reserve account and is holding them over to apply them in July. So in summary, an employee can borrow to make contributions. Contributions cannot be accrued but must be paid. Contributions must be made to a complying superannuation fund. Contributions can be held in a reserve account and applied 30 days after the end of the month they were received. I hope that this presentation has been helpful to you. Thank you very much.